Hello, hello, hello. I hope you're doing great today. Thanks for joining for yet another live event. I actually decided to do a pop up today, so kind of impromptu, not scheduled. So if you're joining me for the first time, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor. Today, I'm active in the space, advising high net worth individuals, family offices, and connecting investors with well vetted cash flowing investments in apartments. I also help investors with deal reviews and the due diligence process. And last but not least, for those willing to do a deeper dive, I actually help them how to analyze deals from beginning to end with confidence and ease through the underwriting community that I lead. So I've been getting a lot of questions lately on what I'm seeing in the market in terms of activity, in terms of deal flow, in terms of deal quality. And so I thought I would share with you a few observations that hopefully will add value to your diligence process, but also set expectations or maybe reset expectations. With respect to deal flow, that has definitely picked up relative to what I've been seeing last year. In the beginning of the year, although I will say in the past couple of weeks, the activity has slowed down a little bit because of the geopolitical events and some of the volatility that has caused, where transactions maybe would come on the market, but discussions and negotiations would stall because again, uh, sellers have certain expectations, buyers have certain, and their investors have certain expectations, and there's a bit of a discovery a process that is happening, but also a bit of an uncertainty on where things will land. We've seen the volatility in rates. At some point the 10-year dropped this close to 4, and now it's back in the 4.5 range, and given everything going on, probably expected to stay that way, maybe even higher depending on how these events develop, and naturally that's impacting the all-in interest rates that buyers or investors are paying on loans, which then impacts the cash flow, loan proceeds, all of that factors into the return. So some deals haven't really transacted, but at least the ones that have gotten to my desk that are already under contract, and potentially the raise is about to begin or has already started, I'm still noticing a lot of enthusiasm from buyers. And um, on average, I review, depending on the week, sometimes it's one a day, sometimes it's one a week. Obviously volume is not equally spread out, but there are a few common reasons that I've observed as to what has led me to pass on those deals. Now, I have a very defined buy box, and what I'm about to share with you is not intended to serve as investment or legal or tax advice. This is just my experience, and it's predicated on my risk tolerance, my buy box, and my investment goals and objectives, which may be different from yours. But a lot of that's also on my end driven by what I know my investor community has been looking for. So I've been adhering to that particular box very diligently. But there are a few key reasons that have caused me to pause and or pass on deals. The biggest one I see out there is cap rates. While there are expectations for the Fed to lower rates, we don't know if or when that will happen. And typically that happens if there is a recession, right? Or situation that would cause the Fed to want to stimulate the economy. And there are very carefully treading waters right now, watching unemployment numbers, watching inflation numbers. While they have communicated that rate decline may occur this year by roughly 50 basis points, that is not guaranteed. And in the grand scheme of things, right, 50 basis points is not a lot. What we also have to acknowledge, however, is that the rates that we talk about in terms of the Fed, these are short-term rates. The loans that typically are put in place when it comes to real estate, these are term loans, 5, 7, 10-year deals. So the treasury rates are a better indicator as to where all-in rates may land. And the 10-year treasury has been hovering around 4.5. SOFR has been around 4.3. So when you add a 1.5 to 2% spread, you're in that 6% range, which is not too far off from where rates have been historically, slightly elevated, but not too far off. And so, as I think through that and look through the long term trends, it's very difficult for me to see an exit cap of say 5% on a class C asset, maybe in a class B in a really strong market. But I see a lot of deals where pretty material cap rate compression is being assumed. And so, based on what I just shared with you with respect to my own observations in terms of where rates are, and for avoidance of doubt, I have no idea where rates would be. So I prefer to be more conservative, and rates are not the only factor, right, that impacts cap rates. So we also have to take that into consideration: the risk parameters of the market, the quality of the asset, all of that impacts the cap rate, the overall demand and supply, right? It's not just rates, but rates is a big one. And there is usually a lag effect, and I've discussed this in prior live events. So cap rate compression is one that would cause me to put pencils down, and again, I understand everyone has a different view on where the market is and where the market is headed, and so it may just be a difference of opinion. But I prefer not to speculate, and I prefer to be surprised on the positive side versus the negative side. So that has been one reason why I've put pencils down on deals. The other one is reserves, right? Now, I know a lot of investors would say, well, but if you raise a ton of money up front for operating reserves and put additional buffers on capex and whatnot, you're effectively tying up investor capital that's sitting idle. And even if you have to dip in those reserves on a temporary basis here and there due to cash flow fluctuation, that's really return of capital. And there's been we can go back and forth on that point. My personal experience, both as a lender and now as an investor, has been that it's not a matter of if, but when unexpected things and surprises happen. And so for me, the reserves is that rainy day fund that I'd like to be able to lean into in the event of cash flow compression or cash flow fluctuations on a temporary basis. I prefer not to have to go to my investors to do a capital call. And again, this is in the context of a traditional syndication structure. And so when I see reserves that are very low, and in many cases I've seen no reserves, and I'm not talking about escrow funds and impounds by the lender, I'm talking about purely um, reserves to cover operating expenses, again in the event of a temporary cash flow compression or fluctuation. So personally, I prefer to see at least 6 months, preferably 6 months of OPEX and debt service. But in many cases, I see 1 month, 2 months, maximum 3 months, and like I said, in many cases, zero. So that makes me nervous because I'd like to have some cushion. Number three is rents. Now, a lot of that is market specific, right? And so it's very important to take that into consideration. It's also asset class specific, but I see way too many or maybe more than I would like to see, cases where rent assumptions are optimistic. Again, if you're in a strong market that has had some rent growth, uh, it's reasonable to assume 2 to 3% in year one. I prefer to see 0% top line growth in year one. Of course, no operator will just sit idle and do nothing. Most operators will look to increase rents upon takeover, even if it's by a little bit. But I prefer, again, to have surprises on the positive side. And so if you assume zero, which is not too far apart with where the national average is, again, the data is always market specific, right? So in some markets you're seeing growth, in others where that are still working through the oversupply, you're seeing decline. So you have to adjust that based on the specific market and even sub-market. But when I see aggressive rent growth projections in year one, or rent growth that's far apart from where the historical average has been for that market, I get a little bit nervous. Why? I talked about cap rates, now I'm mentioning rates. Those two variables have the most potent impact on valuations. Of course, reserves, expenses, the debt structure, all of that impacts the overall return profile of the deal, but those two have a tremendous impact. And if you fall in love with the deal, it's very tempting to tweak a number here and there to make it work, or fit within a certain parameter. But that's not the purpose here, right? The purpose is to get realistic numbers based on the information that we have today and make a best educated guess with supportable data points that we have available today to figure out what that pro forma cash flow and therefore pro forma valuation will be. I'm also observing many trends where a lot of operators may be opting in for shorter tenor debt structures due to, again, going back to expectations of interest rate declines. Whether or not those occur, who knows? And so unless it's a really short-term business plan, um, I prefer not to take that risk. Again, there is always a time and a place, and of course, bridge debt is a great solution, especially for properties that are not stabilized, and you can still find fixed rate solutions there. But hopefully, it's not high leverage bridge debt. Hopefully, it's not variable rate bridge debt, because that would definitely make me nervous. And in that scenario, I would very much like to see the exit assumptions being overly conservative with respect to the refinance. Many deals are assuming refinance in the numbers, so like a 5-year deal assuming a refinance in year 3. Again, I can appreciate why that is given rate expectations, but usually when you put in a refinance in the numbers, then your entire business plan, right, entire deal depends on it. And what if it doesn't happen? What if it doesn't happen at the rate or loan to value you think you'll be able to obtain today? So personally, I prefer not to see it in the numbers. Of course, I would run the numbers to see what it looks like with it, because as the operator is constantly evaluating what that is, and whether it's an optimal time to do a refi. That's the exits are constantly evaluating once you're in a deal, but I don't want the business plan to depend on it. I prefer that to be a bonus, right? If the asset has appreciated in value and market conditions are favorable, to do one and return part of the capital to investors, which then naturally would boost the overall return. But I don't want to depend on it, because if it doesn't happen, then you will be underperforming relative to expectations. So that's it in a nutshell. The cap rate assumptions, reserves, rent assumptions, and here and there I see refinances baked into the numbers. Those would be, at least for me, usually reasons to put pencils down, unless even if I see cushions in other part of the deal. Again, cap rates and rents, like I said, alone have a pretty potent impact. lots of deals that are getting done, also thin margins. That's another um, trend that I'm observing. Again, not a bad deal, not nothing. It's just, but the profits are very thin, leaving again very very little margin or room for error. And in a market like this, and with volatility expected to continue at least over the next 12 months, in many markets still working through the oversupply, which should resolve itself, but that will take time. I prefer to have more cushion than less and protect investor capital that way. So hope that's helpful. Let me see if there are any questions in the chat. Just check quickly, and I don't see anything. So if you do have any questions and would like to follow up further, you're always welcome to send me a DM. I go live on LinkedIn and YouTube at least once a week. And if you do want to learn how to analyze deals with confidence and ease, or you need a second set of eyes and help reviewing a deal, feel free to message me directly, and we'll see you at the next live event. Ciao. I wish you a blessed day.